Welcome to the weekend edition of the Fear and Greed Business Headlines, the week that was, a wrap of the biggest stories over the past 7 days. I'm Sean Aylmer. Earnings, fights with Facebook, commodities and share markets, and more earnings. That's the week that was. Where to start? Maybe equities. Solid rises and solid falls. That's how I'd describe the last week in equities. In the United States, there's what investors call a rotation from pandemic-era companies like the tech stocks to more traditional businesses that do well when the economy's picking up. Driving this shift is the rollout in COVID-19 vaccines and a sharp reduction in new cases and deaths in the world's largest economy. It's happening locally as well, though not to quite the same extent, because the ASX doesn't have the tech titans that Wall Street does. While the local market started the week okay, it got pummeled in later sessions. The tech stocks certainly fell hard, including Afterpay, Zipco, ServiceStream, and PointsBet Holdings, which is an online gaming group. The banks and miners were much more solid, and BHP and Commonwealth Bank spent much of the week trading positions as the largest company on the bourse. In overseas news, China is making no friends whatsoever. Beijing said it faced a critical and urgent task to overhaul Hong Kong's electoral system to ensure that governance in the city was firmly controlled by patriots, whoever they are. It suggests China was pushing further to diminish the region's democracy. An international study found that AstraZeneca's COVID-19 vaccine offered better protection if the second jab was given 3 months down the track. It came as the rate of new cases of COVID-19 in the US was falling fast, with the 14-day average now under 60,000, down 40% on a fortnight ago. The US remains by far the worst hit country, with around 25% of all cases and 20% of all deaths. And Osamu Suzuki, the 91-year-old chair of Suzuki Motor Corp, will step down after spending more than 40 years as chief executive officer or chair of the group. Needless to say, he's been the longest leader of a major manufacturer in the sector. On to local news. In politics, Craig Kelly, the controversial Liberal Party member for Hughes in Sydney, resigned from the party, leaving the government with a precarious margin to push through its legislative agenda. The surprise announcement came after Mr. Kelly clashed with the Prime Minister over social media posts in which he promoted antidotes to COVID-19 not supported by the government, nor by science for that matter. The COVID-19 vaccine rollout commenced this week with an 84-year-old Polish immigrant getting the first jab. Prime Minister Scott Morrison got his in front of the cameras, resplendent in a brash Australian T-shirt. Why does he wear those things? Healthcare workers in the aged care are first in line. The rollout internationally is going well, and Israel this week demonstrated that inoculations work. There was good news for dole recipients, with the government promising to increase the rate by $50 a fortnight. Currently, recipients of unemployment benefits receive an extra COVID-19 payment, but that finishes at the end of next month. The new rate will then apply. Good on the government for doing it. But it's still just a little bit stingy, and surviving on $310 a week in a big city can't be easy. I loved the spat this week between Facebook and the federal government. After a number of phone calls, Facebook boss Mark Zuckerberg and federal treasurer Josh Frydenberg came to an agreement, and the tech giant reinstated the pages of news outlets. The Media Code of Conduct became law on Thursday, and the social media platforms and news outlets are negotiating commercial arrangements. So, what was all the hullabaloo about? Well, it allowed both sides to appreciate each other just a little bit more and work more closely. It also triggered a run of governments from India across Europe and North America to look just a little bit closer at regulating the tech companies. There wasn't a lot of economic news around this week. Wage figures showed a sharp jump in the December quarter. That's just what was needed to try and kickstart some price growth. And capital expenditure figures showed that businesses are spending more and intend to up investments in coming quarters. Next week is a big one for the economy, with economic growth figures and a Reserve Bank board meeting. It was quite a week for house prices, especially if you live in the country. Commonwealth Bank boss Matt Comyn said prices in regions were surging faster than the city, and the smaller capitals, including Darwin, Canberra and Perth, were doing much better than Sydney and Melbourne. First home buyers were back. The lack of immigration and tourists were hurting prices in the big cities, especially apartment prices. Maybe COVID-19 will eventually be considered the moment the dynamics of the Australian housing market changed. On to earnings season. There were some mighty big profits and some mighty big losses. Let's get to some of the worst performers. Scentre, which owns the Westfield Malls portfolio in Australia, posted a net loss in 2020 of $3.7 billion. That's the biggest of the season. The bottom line included a $4.2 billion cost in revaluations of its property portfolios due to the pandemic. Insurer QBE said it lost $1.9 billion for the full 2020 year. It was one of the most expensive years in history for natural disasters claims. The bulk of the claims came from Australian bushfires and hailstorms, fires in the US, and hurricanes in the Atlantic. Qantas lost $1.1 billion for the half year. You really can't make money if no one's flying. The good news is that its domestic business is now cash flow positive, and its freight operations are offsetting losses in its international division. Both Sydney Airport and Flight Centre announced big losses also. Oil refiner and retailer Ampol said it made a full-year net loss of $480 million as it suffered from weakness on refining margins, travel restrictions impacting both vehicle and aviation fuels, and a generally weaker economy. Oil Search produced a poor result, as did engineering group Worley Parsons. The A2 Milk Company downgraded its guidance and was sold off heavily, while Stockland said its profit had fallen 30%. So on to some of the better ones. Supermarket giant Woolworths announced a bumper profit of $1.1 billion for the half year. Consumers stuck at home spent more on food and groceries, liquor, homewares and toys. Chief Executive Brad Banducci said the focus was now on accelerating the retailer's digital capabilities to take advantage of the e-commerce boom. He said it wouldn't be long before digital visits exceeded physical visits across the group. Woolies was a market leader for many years, though Coles closed the gap in more recent years. But the chief executive commentary from both supermarket chains and sales so far this year suggests that Woolworths is just starting to pull away again. Goodman Group is a property company that is doing well, and there's not too many of them. The real estate and logistics giant has benefited from the rush for industrial space, in part due to the rise in e-commerce. It reported a first-half net profit of $1 billion, up 29%. Hearing implant group Cochlear impressed investors, so too did media group Nine Entertainment. Not quite sure how to categorise the buy now, pay later groups. Afterpay and Zipco both announced big losses and their share prices headed south, but they still remain among the best performing stocks over the past year. All the key metrics are going in the right direction. More customers, more retailers, higher value of sales. Afterpay said it was going to raise $1.5 billion to help it expand and then take on the banks in transaction accounts. I want to like the buy now, pay later groups, but it all just seems too good to be true. An interesting trend this week, and in fact throughout earnings season, has been the increased reference to environmental initiatives. Companies that service other firms want to be involved in green companies, not fossil fuel users. Away from earnings, AMP said it had done a $1.35 billion deal with US asset manager Ares Management to sell 60% of AMP Capital's private markets business. Crown Resorts was told the Victorian government will hold a royal commission into whether the gaming giant is fit to hold a licence in that state. Many of the most damaging claims in a recent New South Wales inquiry, including money laundering and links to junket operators who deal with organised crime, related to Crown's Melbourne casino. Bank of Queensland said it was going to buy Members Equity Bank for $1.325 billion, bringing together the 9th and 12th largest banks in the country. It should allow the group to compete better. An online recruitment group, Seek, will split into an operating division run by former Commonwealth Bank chief Ian Narev and an investment company run by founder Paul Bassett. Investors don't like the idea, and the stock was dumped. Now I get to the point where I go through the biggest story of the week, the sleeper story, the most remarkable story, and my favourite story. The biggest news story of the week was the part of the financial market that isn't equities. Bond yields surged, reflecting two things. Investors think the economy is gathering pace, and they're just a tad worried about inflation. US and Australian bond yields are at 12-month highs. They're still well below a normal level, but certainly the return on risk-free money is rising. New Zealand bonds surged because its central bank was told by the government to keep a lid on the overheated housing market. That means it might have to lift the official interest rate. Commodity prices are soaring, and that's putting pressure on the Aussie dollar, which is trading around the 79 to 80 US cent mark. When overseas buyers want Australian commodities, they need Aussie dollars to pay for them. That makes sense. And that pushes up the value of the currency compared to other units. The jump in commodity prices is certainly helping local businesses. mostly the miners, material companies, and, finally, the oil and gas groups. Iron ore is off its highs, but still more than twice the level the government forecast. Copper rose above $9,000 a tonne for the first time in 9 years. Nickel, silver, platinum prices, they're all near multi-year highs. And Australia mines the stuff. We're also one of the biggest producers of rare earths outside China. Those metals go into electronics and batteries, and countries like the United States are looking for places to buy them. And I don't want to forget Bitcoin. After hitting around $58,000 a unit last week, its price tumbled after Elon Musk, the Tesla boss, who has $1.5 billion worth of the cryptocurrency, said it was overvalued. Later in the week, Microsoft founder Bill Gates came out and said there was too much mania around Bitcoin. That's why bonds, commodities, and cryptocurrencies were the big story of the week. The sleeper story comes from market darling Fortescue Metals. Its chief executive, Elizabeth Gaines, apologised after the iron ore miner cleared land on a cultural heritage site in Western Australia without the presence of elders, thereby breaching an agreement between the miner and the traditional landowners. Rio Tinto found out last year that ignoring cultural sensitivities isn't good policy. There'll be more on this one. The most remarkable story is how much money former chief executives of Rio Tinto are receiving. The miner released its annual report this week, and it shows that former Rio boss Jean-Sébastien Jacques, who lost his job over the destruction of 46,000-year-old gorges in Western Australia, was paid £7.2 million last year. But that was beaten by Sam Walsh, another former CEO, who received a deferred payout of $17.6 million. It really is quite obscene. My favourite story this week goes to the number of school kids in Australia. We've hit 4 million for the first time. Most of them obviously weren't going to school, of course. It happened during the COVID year, and that was quite a crazy year to reach the milestone. Government schools accounted for 66% of enrolments, followed by Catholic schools at 19% and independent schools at 15%, according to the Bureau of Statistics. Over the past decade, there's been a slight shift from Catholic schools to independent schools. And that's everything you need to know from the last week. Hope you enjoyed it. I'm Sean Aylmer. I'll be back on Monday morning with the Fear and Greed business headlines. I look forward to your company then.